Kent, welcome to Living Off Rentals.
Hey, thanks for having me, Kirby. It's awesome to be here.
Yeah, it's great to have you, man. I'm excited to dive in today. Just real quick by way of introduction for the audience who is not familiar with Kent Ritter. He's the host of Ritter on Real Estate podcast and YouTube channel. So definitely check that out. He's had some amazing guests on that podcast. He also hosts the monthly multifamily investing meetup in Indianapolis, where he's from. And he's also a partner and managing director at Birge and Held, which owns over 15,000 apartment units and has over 1.5 billion in assets under management, which feels crazy because I think it started in 2008, right? That firm.
That's right. Yeah.
That's insane. I mean, that's some massive growth. That's awesome. So I'm excited to learn some of the keys to that incredible growth in multifamily and help our audience, who's it consists of many people that want to be in the multifamily space or cross over from single family into multifamily, but it just feels kind of difficult and it's intimidating when you hear $1.5 billion worth of assets under management. You're like, that doesn't relate to me in any way. But I think everybody starts from somewhere. So,
hmm
and I know we all started with our first deal. So I think it's important to go back to that and kind of understand your background, because I think people can look at that and get intimidated and think, well, you have always been successful. But I'd love to hear a little bit about how you got started with this and a little bit about your journey.
Yeah, absolutely. And so, Birge and Held has been around since 2008. I have not been with them since 2008. So, but I can tell you that they started two guys with like, I think their first one was like a 20 unit property. So, I mean, everybody has to start somewhere, right?
Yeah,
And
absolutely.
you just grow from there. And the growth is all about systems, putting systems and processes in place so that you can replicate what you're doing, right? And so that other people can do what you've been doing, and you can start to hand things off. I mean, that's the key to growth is delegating, but controlling quality through systems. So anyway, but to get back to my individual story, I was a management consultant for 12 years. And as a management consultant, what you do is you help companies solve problems. And so I got very good at doing that, and just seeing how to run a good business, how not to run a business, more how not to than how to, because nobody
Yeah.
calls you when things are good. But just it was a great experience on what works and what doesn't, and seeing that in a lot of different fields and a lot of different areas, and just managing large scale projects, large scale change. And so all of that experience was instrumental now in my success as a multifamily investor, because I mean, so much of real estate is solving problems, right? If you can solve a problem, you can make a lot of money. So that's really what we do every day. And so anyway, you fast forward in 2015, at that point, I had actually started my own management consulting business with some partners, and we sold that business in 2015. And that's really what kicked off my real estate journey, because I had this capital from selling the business, knew I didn't want all my eggs in one basket in the stock market. So I started looking for alternative investments. And as I did research, real estate really stuck out to me as just the one that really fit the my goals. My goals were to preserve capital, to have returns that are better than the stock market, and have something that is uncorrelated to the markets, right? Something that's not going to go down when the stock market goes down. And so real estate checked all those boxes. And so I started looking into real estate, as most people do, right? When you think real estate, all I had ever been experienced, all I was ever exposed to for people that I knew that invested in real estate were people that were single family landlords, and so that was like, okay, that's how you invest in real estate. You go buy single families, right? Um, well, before I was able to actually get there, I developed a relationship with a guy in multifamily. He's a great mentor of mine. And he led me down the different path. He said, look, do the math on how many single families you would have to actually create the income that you want to have for your family. And I did that math, and it was a hell of a lot of houses. And I was like, that is a lot of transactions. That's a lot of work. He's like, well, instead of going and buying 100 different houses, buy 100 units under one roof in one transaction. Because it is true. Like from a work standpoint, there's not much difference from buying like a fourplex than buying a 200 unit. I mean, in all honesty, you go through the exact same process. It's just takes longer because there's more units, right? But the thing that takes really longer is just walking the units. Everything else is really about the same. So anyway, so I went right into multifamily, kind of skipped over that step, went right into multifamily, started first passively investing with other sponsors, other people that were syndicating deals, because I recognized there was a lot I didn't know and I wanted to learn the game, right? So I started reading all the books I could, listen to all the podcasts I could. I went through 2 mentorship programs and completed those programs, and but still felt like, there's more to learn. Like really hadn't done my first deal yet. Right. And
Mhm.
so I started investing passively, really saw that as a way to continue my education, kind of get into this, see how deals actually work. In 2016, I went out and invested in 10 deals with several different sponsors, really just to get spread geography, see how different sponsors work, and all with the idea that eventually I wanted to be active. I wanted to be doing these on my own. Never with the idea of doing what I'm doing now, but just this idea of building up my own little world, right? My own little portfolio, and generate income and just live off that. But over time, and just seeing how syndication works, and just the understanding what syndication is, and this idea that you can actually go out and pool your money together with others and buy something bigger and better than you can on your own, and rely on the expertise of someone who really knows the business, was extremely appealing to me. And I thought, wow, that's something that I want to be invested in, and then ultimately something that I want to do on my own, and I want to be able to create value for other people. And so in 2009, so you fast forward 2019, did my first acquisition, my first syndication acquisition. I was 250 units down in Atlanta, 2
Wow.
properties. It
Started big.
was, yeah, started big through a partnership though, with people who are more experienced than me. And I think that's, again, right. It's all about the way that you grow quickly is by finding partners who have that experience and being able to add value to them and being able to kind of. So I'd say I very much wasn't leading that deal. I'd say I was sitting shotgun in that deal, right? But I was helping underwrite, helping with asset management decisions now that the deal is live, helping raise capital, helping with investor relations. So I was helping in many different ways and gaining a ton of experience, right? And the whole time I'm asking questions, why are you doing this? Why are you doing that? Right? Same thing I was doing when I was just purely passive as well,
Mhm.
just continuing to learn. Um, so then fast forward, 2020 actually, and Birge and Held actually was one of the firms that I started investing with in 2016. And so that's how I built that relationship with them, is through several investments and
Got it.
just asking questions, coming into the office, meeting people. Right. In 2020, after having a fair amount of success of my own, they asked me to actually come on board as a partner and build out a line of business under their umbrella, and to really focus on a different strategy. So they were actually adding a different strategy to their portfolio that I was running. So in 2020, we acquired 3 properties within that strategy, and I can tell you a little bit about that strategy. 3 properties, and then a 4th in 2021. And so, I mean, really just we were just off to the races, and really just rinse and repeat model, and bring in investors, and creating a ton of value in these deals that we're finding. And now I'm actually at the point where I'm transitioning out to actually begin be the lead sponsor on deals on my own. And so I'm kind of going through this transition. But the entrepreneur in me, at the end of the day, I just have this itch to do it under my own banner, and own it, and be able to kind of set my own path. And so excited to be kicking off and really starting this new business with the experience I've gained and the amazing relationships that I've gained along the way.
That's awesome, man. That was one of the questions I had, was around that transition from doing it yourself to doing it with a firm, and then now I guess doing it yourself again.
Yeah.
So I want to get to that. Also want to get to the line of business that you were managing specifically.
Yeah.
Um, but I just want to highlight something that you brought up, in terms of the way this progressed for you. I think it's super smart the way you did it, being a passive investor, which for those that aren't familiar with that term, it just means, you basically are taking a sum of money, investing into somebody else's deal that they're syndicating, they're
Hmm.
sponsoring. And then, you're sitting kind of on the sideline, but you're a owner, you own equity in that property. And so
That's right.
they're updating you like an owner. You have access to the property. You can ask questions about the property. And so I think that's such a smart way to get started. I'm a passive investor in properties as well, and I've learned so much from that process. And so I think it was really smart the way you progressed into this, as opposed to saying, I want to be in multifamily, I'm going to go out and buy a 250 unit property tomorrow, and getting yourself in trouble potentially. So
Yeah, and that was, and that was really through good mentorship, because there was a point where it was like, okay, I know I want to be in multifamily now, so okay, I'm going to go out and buy like a 50 unit, and I'm going to own it myself and run it. And again, a mentor said to me, well, great, but you go out and buy that 50 unit, you spend all your money, then what next?
yeah, yeah,
And I'm like, well, good question, right? And so he's like, that's where syndication really came into play, where look, you can, instead of putting all your eggs in one basket in one property, again, it allows me to diversify my own money, because I invest in each deal. Typically about 10% of each deal is my own money. And
mm,
so I'm investing right alongside the investors, but it allows me to diversify into different properties as well. And so it's kind of that win-win approach, of never putting, general rule, just never putting all your eggs in one basket.
yeah, yeah. It's smart. And I kind of, we talked a little bit before this about my experience with multifamily. I just sold a apartment that I bought in Noblesville, Indiana, and kind of looking back, probably would have been smarter to not, I just bought that one myself, and kind of treated it as a single family. We rehabbed the
Mhm.
whole thing, and then got it rented out. But I struggled with the management aspect, and it's because I've never managed multifamily, and I don't know what to look for, and that
Mhm.
sort of thing. So I think that this approach of partnering with people who have done it is really smart. Especially to get your feet wet and know what the pitfalls are to watch for.
Yeah.
Um,
Yeah,
so
absolutely.
so another aspect that you brought up when you're initially talking was, this debate that you had initially between single family and multifamily, and
Mhm.
we have a healthy debate on this show quite often, because there's, like my last guest who came on the podcast is probably one of the biggest single family investors in Chicagoland area. He owns, I think, over 230 single family units. In around Chicagoland area, Raul Vasal. And, we talked about this, and I said, why have you done this for the last 10 years, buying single family? Why haven't you crossed over to multifamily? And he brought up, some good points. I think, the economy scale is obviously one of the biggest factors that you have in your favor as a multifamily investor.
Mhm.
He likes the control aspect of the single families. But can you kind of share a little bit more about some of the advantages of, to kind of maybe some counterpoints to his arguments for the last from the last show?
Yeah. Well, I mean, first of all, I would just say that, look, both strategies work, right? I mean,
Mhm.
I think in the environment that we're in, rentals work. And whether those rentals are single families or multifamily, I think you're going to make a lot of money. In an environment where assets are appreciating as quickly as they are, um, you can also just benefit in single family from that neighborhood appreciation, right? So in this type of environment, yeah, you can make a lot of money buying single family houses. The trouble is if we're in an environment where we're not seeing a lot of asset inflation, um, you don't get much appreciation in single family houses, because single family houses are valued by the market, right? Your house is worth however much relative to what the houses next to you and in your neighborhood have sold for, right?
Right.
Well, in commercial real estate in general, and then in multifamily, you know, they're valued based on income. So the value of as the income of the property increases, the value of the property increases. And what that's called is forced appreciation. So you're able to actually control the appreciation of your property versus in single family, you're leaving it up to market forces, right? So if I go in and I add additional amenities and I improve the units and I increase revenue and I increase the net operating income, I am then just, it's a math problem, increasing the value of the property. So you can control that. You can force that appreciation. That's one of the huge benefits of commercial real estate over residential real estate, and multifamily just being part of commercial real estate. Um, then yeah, for sure, economies of scale come into play, and economies of scale from purchasing, but also just from standardization, right? So if I have an apartment where I have, which I do, so let's just talk about it. We'll talk about a 50 unit that we have where, um, hot water heaters are all the same, appliances are all the same, cabinets, floors, countertops, everything is the same, right? And so our maintenance guy is really good at fixing those things because they're all the same. If you buy 200 different houses, you're likely going to have, I mean, you could at an extreme, 200 different types of water heaters, 200 different types of microwaves, 200 different types of other appliances and flooring, and there's just so much variation. Um, and the other problem is, if you have a single family rental and you don't have a tenant, who's paying the mortgage? The owner,
Mm-hmm.
right?
Yep.
And with multifamily, with our properties, because we do the math on this before we purchase a property, for most of our properties, we could go to 60 to 70% occupancy and still be at break even.
Mm.
So, and our properties are anywhere from 95 to 100% occupied. So we would have to have a
Yeah.
significant drop in occupancy to get to the point where the mortgage would fall back on us, right? And so there's just that
Mm.
protection of that tenant diversity, right? And I think there's a lot of value in that.
Yeah, that makes a lot of sense. Yeah, yeah, and so one of the things that I've thought about a lot with multifamily and have tried to wrap my head around is, since basically the last crash in '08, the market conditions have just improved. People said after the crash they lowered interest rates. They're like, "Oh, this is the best interest rates we're ever going to see,"
Right.
and since then they've lowered and lowered and
Right.
lowered. So, it has made a lot of people look really smart in this space that, maybe it's some market factors that are kind of contributing to that. So what I've been, trying to mitigate for my portfolio. I mostly invest in short-term rentals, and single family homes, but I'm trying to wrap my head around this for multifamily is what happens when things go the other way. If when interest rates start going up and the conditions are working against the investments,
Mm-hmm.
how are you guys mitigating for those factors?
Mm-hmm. Well, so I guess just as far as, so you're absolutely right. Like I remember in 2014, people saying we're at the top of the market,
Yeah.
can't go any higher. And
Yep.
here we are 6 years later, seven years almost later, right?
Yeah.
And things have gone higher significantly. And what the Fed is saying, which is a policy change, a policy shift, is saying for the first time they're going to let inflation run, meaning they're not going to raise they because the Fed for since like 70s or 80s, I don't remember when, they've targeted 2% inflation growth, right? Well, if we even got a sniff close to 2%, they would take action. They would raise rates and do things to prevent that from happening. So like we've hardly ever actually hit 2% inflation. Um, And now what they've said is that, well, now what we're going to do is we're actually looking for an average of 2% inflation, right? Which means they're going to let inflation run higher than that to reach an average of 2% because it's been below forever, right? So the Fed is saying that they're going to let inflation run, which means interest rates aren't going to go up. So I guess like one is like we need to be realistic about the environment, and just because it hasn't happened before doesn't mean it's not going to happen now, right? It doesn't mean
Yeah.
just because you don't think, I mean, people are saying the same thing now they were saying in 2014.
Yeah.
If I was a betting man, which I am, I would bet that in 2023 we're going to be in a very similar environment where interest rates maybe have crept up some, but not much, and not in a material way. So so anyway, so that's kind of where I think the environment really goes. I think that I think what you're going to see is a ton of asset appreciation,
I see.
right? I don't know that you see a lot of income like wage appreciation
Hmm.
because like the globalization of the economy has stopped a lot of that, right? Because if wage inflation doesn't happen because companies go to China or the Philippines or somewhere where labor is cheaper, and that's what happens. Um, but I do think that you'll see a lot of asset appreciation, right? We're seeing it in houses right now. Houses in Indianapolis went up 15% last year, and they're on track to
Wow.
beat that this year. Like it's crazy. So anyway, but maybe that doesn't happen. Maybe we go into recession, right? Maybe
Yeah.
interest rates go up. Maybe we're in a tough spot. Well, recessions last historically between 11 and 16 months. So, and what happens on the other side of recessions? Well, in all of history, things have gone up on the other side, right? The recession
Hmm.
kind of culls the herd,
Yeah.
right? And then the things that are still there, have room to grow and improve. Um, so we need to be able to manage through that dip, right?
Yeah.
And so to manage through that dip, a couple of things that we do. Well, one, we lock in interest rates right away. We do fixed debt, and usually it's 10-year fixed debt. So even if interest rates rise, we're locked in for 10 years, even though we're targeting 3 to 5 year hold periods.
Mm.
And people ask me all the time, well, if you're targeting a 3 to 5 year hold period, well, why do you get 10-year debt? It's like, well, just the way that debt curves have been, 10-year debt in the past year and many times has been cheaper than 5 or 7 year. So
Mm.
there's just that practical matter. But also we like to have that stability and that confidence that, so say we're targeted to sell in year 5, but in year 5, we're in the middle of a recession, right? And say it's a worse recession than we've seen since the Great Depression, right? And we gotta hold for multiple years. We want to be able to do that, and we don't want to be forced to sell in a negative environment, in an environment that's not conducive of selling, right? So that's one reason. Now on the front end of that, we actually have been paying a little more on the rate to have the flexibility to lower our prepays to take advantage of the market if the market does continue to grow like it is, to be able to sell in 2 to 3 years, and not pay huge penalties. There's so much
Mm.
equity locked up in apartments right now because of something called yield maintenance, which what that means is if you're trying to sell early, uh, you essentially have to make the lender whole. And so with interest rates being so low, you owe the lender a ton of money. Like you could have 2, 3, $5 million in prepayments, trying to sell a property. So there's a
Wow.
lot of properties that are stuck right now, in that case because interest rates have dropped so much. So without going on too much more of a tangent, the things that we do to mitigate all of this, one is long-term fixed debt, with flexible prepayments on the front that make we get flexibility on the front end, stability on the back end, right? The
Yeah.
other is, really since COVID and even now, we're just putting more cash reserves into our deals, like doubling cash reserves in our deals, just as
Mm.
a rainy day fund, right? Because you don't know what's going to happen. And so, luckily through COVID, I mean, our portfolio performed extremely well. And really what our portfolio is made up is like B class workforce housing. So folks that maybe make between 40 to 65,000 a year for the most part, and renters by necessity versus by choice. And those people have stayed and they've paid. And so we don't expect, I mean, we were kind of just waiting around in 2020 for like the next shoe to drop, and for us to, and we were really at battening down the hatches and saving cash and all this. Well, we still are, but I think we're coming out of it now. And so we're still being conservative in that way, just putting more cash into the deal, more reserves. Right. And then the other thing that we do when we underwrite is we underwrite for cap rate expansion. And what that means is, like, the value equation for commercial real estate is the income divided by the cap rate equals the value of the property. Right.
Right.
And so
Yep.
what that means is that as the cap rate goes lower, the value of the property increases. And that cap rate is based on a lot of different things, quality of the property, but also the market and what market you're in. Um, but so as the cap rate increases, the value of the property decreases, right? So when we underwrite, we're typically assuming that if it's a 5-year hold, cap rates are going to be 50 basis points or a half of a percentage point higher when we sell than they are right now.
Okay.
And so if cap rates stay flat, like, it's all gravy. It's great. But
Yeah.
we're factoring in the fact that they could increase because they are historically low. If you look back in history, I mean, Indianapolis is selling apartments in a 4 cap environment right now, and that's never happened before. So we
Yeah.
prepare for that. And so if it does increase, well, good, we've planned for that, and we'll be on target for the returns to our investors. If they don't, all the better, we can under promise and over deliver. So those are some of the main ways that we kind of prepare for potential downturns in the future.
Yeah. That makes a lot of sense. I think that long-term outlet or outlook makes so much sense because so many people are so concerned with all the news stories that, are just driving fear most of the time,
Man,
and
yeah,
they're investing
like,
based on that.
yeah, like please don't invest off of what CNBC says.
Yeah.
Like, that's just, please don't.
Yeah.
You got to have a longer term look, right?
Yeah.
I mean, we're not day traders
Yeah.
here, right? We're real estate investors.
And
And, the other thing I would say is we're spending less money on the interior of the properties.
mm,
That's the other thing. The other way you manage your risk is by managing your cost basis. And your cost basis is how much you bought it for, and then how much you spent renovating it,
yeah.
right? Because the only way you make a profit is by getting above that,
Yeah.
right? So the higher that is, the higher the hurdle you have to then sell for to make a profit. So spend less. That lowers your risk.
Yeah.
And
How are you
so,
I'm sorry. I
oh,
was
so
just
I
gonna
was,
Yeah, go ahead.
yeah, no, so I was just going to say that we are, what we found really drives value is less money on the interiors and more money on the exteriors. And
Okay.
and I think where people usually get in trouble is they over improve the interiors
Mhm.
because they think of it as what they would want in their house, right? Like, oh, they would want granite countertops. Well, if you own a property that is in an area where the average income is maybe 45,000, um, those people are not used to granite countertops and do not expect granite countertops, and they're not going to be able to afford the rent that you need to make your return on your granite countertops. So don't put granite countertops in. It's going to be a waste of money. And so just things like that, and just being smart about what you're improving. Cabinets are one of the most expensive things that you can buy or replace. So the more that you can avoid that, the more you can save the boxes. I mean, even if you put new doors on, paint them, put new pulls on the doors. I mean, they can look brand new as long as the boxes are solid. And those are ways where you can save money, again, and lower your risk.
Yeah, that's a great point. Uh, uh, so you mentioned that you're underwriting based on increased cap rates or projecting, potential for 50 basis points higher. How are you remaining competitive with, as crazy as this market is? How do you underwrite in those extras? Because it seems like every time I've looked at multifamily, it's like whoever's willing to pay the highest is going to get it, and there's no kind of um, it's hard to underwrite extra value in there or a safety net in there.
Oh, I agree. It is difficult. It's a volume game, man. I mean, we
Okay.
lose 10 times the deals that we win, be just because
Yeah.
of that. So it's volume. It's just you've got to be looking at hundreds of deals. You got to be putting LOIs in on dozens of deals, and then you'll get one deal. And so, I mean, it's not easy, and it is hyper competitive. I mean, I don't invest I invest pretty much in the Midwest because I believe in the Midwest. I think it's
Mhm.
undervalued relative to the value that can be created here. And I like that. Like, I hate when I see Indianapolis on lists of like top 10 markets to invest in and things like that. I'm like, no, I want to stay under the radar. Like,
Yeah.
stop coming. But if you go to, you go to some of those hotter markets, and Indianapolis is even seeing this, is like, it's not uncommon to have 20, 30 groups bidding on a property. And in that environment, there's no way that you're going to buy that right. And it is true that you make your money when you buy. And it goes back to that. What's your cost basis? What's that hurdle you have to get above? And so if you're just paying 10%, 15% above asking, you better hope that the market continues to improve through your whole hold period. You're putting your future in the hands of the market. And so I think you just have to recognize that and be willing to take that risk. Um, the way that you get around that is by building really solid relationships with brokers, so that before it gets broadly marketed, they call their short list and say, "Hey, I know that you'll come through. I know you'll close on this deal. Um, and so do you want to take a look at it before we spend the time and effort to broadly market it?" And that's how you can still find deals in this market.
Yeah.
And so it's really, I mean, broker relationships are critical. The other way is you do a direct to seller approach, which again is just a very high volume play. You got to be willing to get a lot of no's, um,
Yeah.
and it's pretty inefficient, but it can work.
Yeah. Yeah. Interesting. Yeah. You mentioned the rehab or the improvements of the properties. I saw on your website that you guys have designed a process to do 8-hour rehabs, basically, of units. Can you explain how this works? I've always told people that the most expensive part of rehabbing, because I've rehabbed lots and lots of houses over the years, and always the most expensive part is the time factor.
Oh, absolutely.
The
That
flip.
downtime.
Yeah,
Yeah, that
exactly.
downtime, that
Yeah.
lost revenue. Yes. So yeah, Birge and Held has created a 8-hour turn process, which is pretty incredible.
Yeah.
And they actually do that. They do it occupied. So basically, the resident leaves in the morning and comes home to a brand new apartment. And it's through trial and error, and I think about 6 to 7 years of trial and error and practice to get that down. And I know it was something that they started with an external contractor and then brought that in house over time. But yeah, it's great. I mean, the reason that it's so good is to your point, um, taking out even all the efficiencies of just lowering your general conditions on construction by compressing the time, and lowering labor costs, and being able to bulk order materials and supplies and things. Taking all that out of the equation, the real value add is you don't lose occupancy. So Birge and Held, uh, they renovated a 750 unit property in Indianapolis in 11 months, including the exteriors. And through that entire time, maintained 94% occupancy because they were doing them occupied.
Yeah.
They don't have to wait till turn, and then the unit's down for 2 weeks, and you're losing revenue, and then you got to get somebody in there and go through that whole process. So that's really the game changer, is the ability to maintain that occupancy through the process and condense the construction timeline.
Wow. So you must just have teams of contractors and checklists and processes that they just stamp out the exact same thing in each one.
Yeah, exactly. I mean, it
Yeah.
takes a tremendous amount of coordination
Got it.
between the
Yeah.
construction team and property management. And so I think one of the reasons that Birge and Held is able to accomplish that is because they've got internal construction and internal property management. Um, it's all in house, so just working together.
Got it.
Um, and yeah, it is definitely a value creator.
Yeah. Wow. Can you share a little bit about the line of business that you were responsible for at Birge and Held? That you said it was a new type of
Yeah,
investment,
yeah.
and what drove the firm to want to get into this?
Yeah, and this is the strategy that I'm carrying forward on my own as well. I think
Okay.
what we discovered at Birge and Held is just they're at a point in scale where with the amount of overhead, they just have to acquire big properties for it to make sense. And so it was a great experiment to try, but ultimately, I'm taking this strategy and continuing forward. But it's really the strategy is just kind of if you're we're kind of the salmon swimming upstream, I would say, where we're looking for small to medium sized properties, and that's relative, right? So I'll say what that means. I mean, anything kind of under 150 units. I'd say like 30 to 150 units, um, and in secondary and tertiary markets. And often, and the reason that's a sweet spot is because the institutional players, the big players like the Birge and Helds of the world, like I said, because of their size, they need to deploy a lot of capital. So they're looking at 200 plus unit deals. So there's a lot of people, including REITs and institutions, everybody else that floods that space. Um, and then kind of below that 30 unit, you have a lot of the mom and pop investors, a lot of the individual investors, right? But a lot of those folks kind of, get out of the 30 units plus, kind of gets out of their range for a lot of people if they're investing individually or even with a small group,
Mhm.
right? So there's a sweet spot there that we can play in where there's lower competition. So the buyer profiles are different. There's just less buyers, and the seller profile is different as well. Because if you're buying a property from a sophisticated group, they've squeezed that turnip. They've gotten all the juice out of it, right? So you are relying on the market to continue to appreciate, right? Versus buying from somebody who maybe is an attorney and has owned the property for a few years and kind of run it part time. Oftentimes those folks really manage for occupancy versus maximizing revenue and income. So I've purchased 3 properties in the past year that are the textbook example. Somebody had them as really a side investment. They have a full-time job and they self-managed, and the properties were 100% occupied, but anywhere from 100 to $200 below market rent. So
Mm,
we look at that and say, wow, we can come in and provide immediate value without even touching the units, just bring them up to market,
yeah.
and add additional amenities, add additional fees. We do some other things such as maybe renting washer and dryers. We will actually run fiber optic. We have a deal with a company where we'll run fiber optic to the property and become the internet service provider. And then,
Mm,
so people pay us instead of Comcast, right? And so different revenue streams we're creating on the property, and in a property like that can create tremendous value for our investors. And so there's just more meat on the bone, right, in
yeah.
this type of thing. So that's really just niching down, finding these diamond in the rough properties that have this meat on the bone where we can still create tremendous value. And yeah, and that's the strategy.
Got it.
So within Birge and Held, I came on, we built a team, we were going out acquiring those properties, sourcing our own equity, sourcing our own debt, really doing it from start to finish. But at the end of the day, as we just talked, that they're just kind of at a scale where these smaller, even a 50 unit, even a 110 unit doesn't fit kind of their need for the overhead.
I see.
So, but I still very much believe in the strategy, and that's why I'm taking the strategy, on the road myself and
Yeah.
continuing to implement the plan.
And how do you make the management work on those? Because that's been my biggest struggle when looking at these is like,
Yeah.
and that's what most people say is once you get over 100, then you can have on-site staff and that
Yeah.
sort of thing. But below that, you just don't have the scale enough to pay for it. So how do you make it work?
Yeah, so that is the hardest part about managing a 30 or a 40 unit, or about owning one is how do you manage and how do you get good management? And so what we've created is, um, first in Birge and Held, and now I've partnered with a property manager in developing this outside, is really what we call like a scatter site management strategy, where we may have 200 units in a fairly tight geography that a manager can manage and a maintenance team can maintain, right? So it's total number of units versus a specific property,
Okay.
and that's been very successful.
I see.
So it's
Got it.
it's kind of like people have zones.
Mm, okay. It's like a team of teams.
Yeah,
I'm a
yeah, that's a good way to
veteran,
put
and
it.
General McChrystal wrote that book.
Yep.
It was like the way they started winning, in Iraq was this sharing of knowledge and having small teams that all,
Yep.
talk to each other, and you could utilize that economy of scale, even if they're not on site.
Yeah,
So
exactly right.
yeah,
Exactly right.
that's
So
interesting.
it's definitely more difficult than just buying a property where you can have a full payroll and sitting someone in that office, right? But again, real estate's all about solving problems. The reason people don't buy those properties is because it's hard to manage. When we solve that problem, again, we create a ton of value.
Yeah, absolutely. That's awesome. I feel like I could continue to pepper you with questions all day because this is really interesting, your take on this. But I'll start to move to wrap it up. So as you're transitioning into your own thing, I'm sure there's probably nerves around it, and there's um, some intrepidation. I'm going through a similar situation. I had a full-time job as a CFO of a nonprofit, and recently transitioned out of that back to real estate full-time.
Mhm.
And I'm always curious how people approach this transition and goal setting and that sort of thing. So for you, what's your goal with the new organization, and how are you approaching this transition? What are some of the things you're doing right now that you think will add to success later on?
Yeah, that's a good question. I mean, there's it kind of I think it goes back to just I don't know how I approach maybe life and everything a little bit. It's so I'm a big believer in goals. So I have goals for everything, from business and family and personal and health. And I think you have to be uh striving to achieve something. Otherwise you're just staying stagnant. And so
Hmm.
so my general belief in life is the more time I can spend outside of my comfort zone, the better, and because when you're outside of your comfort zones, when you're growing. And so
Hmm.
like for me, like doing podcasts used to be very uncomfortable. I'm not just I'm not a self promoter, I would say, but now it's become something that is very comfortable, and it just through repetition,
Hmm.
right? So I guess the reason I say that is because the way that I'm approaching this is kind of just the way that I try to approach life. I think first of all, it's not an easy thing to do, and whenever you're trying to do something that's not an easy thing to do, you have to be really clear on why you're doing it, because willpower will only push you so far. You can only force yourself to do something for so long. Anyone that's tried to diet, right, knows this, because people approach diets through willpower. Like, this sucks, but I'm going to stick it out, right?
Yeah.
That thing, and it doesn't last. Um, that's very much a push approach, right? Or I guess it's the pull. You're kind of pulling yourself along, right? If
Yeah.
I may get this analogy right. Versus the other way you do it is you get really clear on your why and why you're doing it. And so the reason that I do everything is for my family and to create a wealth for my family and the type of life that we want to live. And really the reason that I sold the other business was because in that business I didn't have the time to be the type of husband and father that I wanted to be. I was traveling around the country, gone all the time, and I wanted to create that time freedom to be a dad that's at every soccer game and every dance recital, and that, like, that's the type of dad I want to be.
Hmm.
And and so anyway, so I'm very clear on my why, and that why is what powers me through the really hard times, because that pushes you along, and you got to create an emotional connection with that why. Um, to be able to do that. And right, but that's what pushes you through. So part of it, like, just to being an entrepreneur, like, you got to have very clear vision on your why so that you can get pushed through the tough times. I guess from a practical standpoint around planning, I mean, it's just being organized. I mean, this is not my first time of, starting up a business. So I have previous experience, which is helpful, but I think you got to be very well organized, and you got to take it one thing at a time. And you've got to know what really moves the needle and focus on those things, because it's very easy to get distracted and just try to spend, I got to work on a website, I got to work on the podcast, I got to do this and this and this. And if you spend a half hour working on everything, you move an inch in 1,000
Yeah.
directions. You've got to be able to move a mile in one direction, right?
Yeah.
And so it's
Yeah.
like understanding your priorities, focusing on the things that really, I mean, there's probably one or two things that you do in a day that, like, really move the needle on your life. All the rest is noise. And
Hmm.
so figure out what those things are, focus on doing those things. And then the thing that I've really learned, this is something that's come more recent to me, is you got to be willing to ask for help, and you got to be willing to go out and find that help earlier. I was very much, I want to do it. I know I can do it the best. I'm going to slug through, even if it's something I'm not good at. Now I'm very much focused on knowing what I'm good at and focusing on my highest and best use, and trying to delegate everything else, even if I'm spending the money up front before I have the income, like in this business, right? Um, because I know that that's what's going to allow me to scale, and that's what's going to get me from A to Z much faster, right? Than kind of limping along, doing
Yeah.
doing it all yourself. So, um, yeah. So those are kind of general lessons
Yeah.
that I'm trying to approach as I build this new venture.
That's great advice. That's great advice. I can certainly relate to a lot of what you just shared there. So it's really great advice for someone who's maybe thinking about going through the same transition, whether they're leaving a full time job or just
Yeah.
transitioning into real estate investing in general. So that's awesome. If people are listening to this and they want to maybe get involved with you in your new venture or just
Yeah.
learn more, what's the best way to reach out?
Yeah. So you could go to kentritter.com, KENTRITTER.com. And that's my home base. So you can see my blog there, check out my podcast. I have investor resources there, like terminologies, FAQs, different things. And so that's a great way to get to know me. It talks more about my personal story and my journey and what we're doing. The other way is through my Ritter on Real Estate podcast. So if you're interested in investing, that podcast is all about how do you become a smarter, better multifamily investor. And so, we talk to all kinds of different people, from accountants, attorneys, insurance people, investors, operators, the whole gamut, and just get their tips, right? And then lastly, I mean, you can reach me on social media. I spend most of my time on LinkedIn, Kent Ritter. You can find me. You can find me on Instagram, Facebook as well. But happy to have conversations to try to help anybody get started. I had so much help getting started, and that's why I've gotten so far in such little time. And so I really believe in just giving back and trying to help other people along too.
Awesome. Awesome. Yeah, it is a great podcast. I highly recommend people checking it out. Kent, I really appreciate you taking the time today and sharing your knowledge. I know this is going to be super valuable for this community. So thanks for coming on.
Great, Kirby. Thanks for having me. And yeah, I hope people find it valuable.